Let's get more insight as to whether it was a healthy dose or not. Malcolm Etheridge is with us, Executive Vice President at CIC Wealth, about $850 million in assets under management. And Malcolm, I mean, you weren't that surprised by the volatility, at least in the tech space. Are you calling it healthy, though?
I don't know that I would call it healthy necessarily, since I saw a report, I think it was Friday of last week, that basically pointed out that we're almost at the same record lows as we were back during the dot-com bubble, or I guess I should say like right at the time the bubble was bursting back in the 2000s. And so I don't know that I would call it healthy necessarily, because there are a lot of people who got hurt then, and I suspect a lot of people who are getting hurt now. So we're not all that surprised to see, some of those high-flying tech names that the valuations in them just made absolutely no sense, and we've been calling that out pretty much since the summer of last year, telling people to diversify out of that mega cap tech trade while they had time. It's not all that surprising, but I won't say that it's necessarily healthy to see as much of a slide as we have been.
The big question, though, right now, Malcolm, is that a lot of folks don't necessarily want to exit the market per se. They want to look for another place to park their money here. So when you talk about rotation and you talk about what you find attractive in the equity space, where do you find it?
Yeah, so surprisingly, historically, the S&P tends to do well during periods of rising rates. Historically, at least, right? Obviously, history is never an indication of future performance, but we expect that the S&P will actually be the stronger index, if you will, coming out of this period throughout 2022. Not that that necessarily says anything when you compare it to a NASDAQ that I just pointed out has been getting whacked around. But we also see opportunities in healthcare and real estate.
The S&P ends up being the outperformer. Why not something like the Russell? Why not something like some of the smaller and mid-cap cyclical names?
Yeah, so the challenge with the Russell right now is just that the cheap money is all but spoken for, right? So where we talk about the Fed taking away the punch bowl is the term that I hear people use all the time, right? All the monetary support that we've enjoyed the last couple of years, especially in the markets, that tends to help your smaller companies who can borrow very cheaply to grow. Not that it doesn't help the bigger ones too, but the Russell gets helped out by that kind of support. And with that being taken away, it's tough to predict that they're going to be able to finance that growth, that future growth, the same way that they have been for the last couple of years.
So let's talk about that punch bowl, the impact on the markets. We've heard from a lot of strategists on the street, the latest being Ed Yardeni. He writes, and I quote, Fed Chair Jay Powell and his colleagues have made this more painful and more prolonged than it has to be. My message to the committee, the labor market is strong. Inflation is a problem. Can we just get on with what needs to be done? Do you agree? Have we waited too long?
We are certainly in the camp that is not surprised that it's taken Powell this long to make the hard decision, to do the hard thing. But we also agree that he should have done the hard thing a while ago. And frankly, I would even throw in there, you didn't ask this, but we'd even throw in there that the reason he's making the tough calls now is because he has nothing to lose, right? He's already gotten renominated, and so that part is off the table. And so if you just compare, a second-term president to a first-term president, it's much easier to make the unpopular decisions when you really don't have a ton to lose in that respect. And so we're in the camp that's also in agreement that we might even see a half-point raise out the gate to start off this thing. And that's kind of being factored into some of the sell-off that we saw throughout January, but not necessarily. We think, it becoming a reality and that half-point raise actually happening will certainly cause some turbulence and once again, some heartburn in the month of March.
Talk us through that heartburn, that turbulence. Is it a yield curve, a curve that steepens or flattens? Is it a movement in the bond market that has repercussions in tech in particular? Where do we feel the pain?
Yeah, so it's tough to even call out what will happen in the bond market with respect to the stock market the way we used to be able to. We used to be able to say, interest rate moves like that will impact bonds, and that impact on bonds will obviously have an inverse relationship to the stock market. And so if you believe bond market's going to move this way, then that means the stock market's going to go that way. And so jump in. But history, again, isn't really ringing true in this case, where that inverse relationship has kind of gone out the window, at least in the last decade and a half, 2 decades, right? We used to have that seesaw effect, and now they're kind of moving in tandem. So to answer your question more succinctly, I think we're going to see both of them taking a bit of a hit in tandem now, bond market and stock market, because of that aggressiveness of the Fed. That's not really something we see very often from especially Fed Chairman Jerome Powell, but Fed Chairman in history, period. They're usually not all that aggressive. And so it's going to catch a lot of people off guard, even though they've been doing what they can to kind of get it out there that, yes, we see that inflation has gotten out of control. And now we are prepared to act swiftly.
All right, Malcolm, wonderful to get your insights here on this program. Malcolm Etheridge there. He's the Executive Vice President over at CIC Wealth, helping us kick off the big show today here on this Tuesday afternoon.